Loss aversion is a common psychological phenomenon, where people feel the pain of losses more intensely than the pleasure of equivalent gains. This tendency often leads to irrational decision-making in the stock market, hindering long-term success. What is loss aversion? Loss aversion is a concept from behavioral economics introduced by Daniel Kahneman and Amos Tversky. It explains why investors often hold on to losing stocks too long or sell winning stocks too quickly to lock in gains. Example: if losing $50 feels worse than gaining $50 feels good, that's loss aversion in action. Why it matters. This emotional bias can derail investment strategies, making it hard to stick to logical plans. How loss aversion impacts investment decisions. Holding on to losers. Investors often avoid selling stocks at a loss, hoping prices will rebound, even if fundamentals suggest otherwise. Premature selling of winners. Fear of losing profits can lead to selling successful investments too soon, missing out on potential growth. Overtrading. Frequent buying and selling due to emotional reactions can erode returns due to fees and poor timing. Psychological roots of loss aversion. Fear of regret. Investors fear making the wrong decision, leading to inaction or irrational behavior. Anchoring. Attaching emotional value to an investment's original purchase price and viewing any decrease as a failure. Overconfidence. Believing you can predict market movements, leading to emotional rather than rational decisions. Strategies to overcome loss aversion. Develop a strong investment plan. Set clear goals. Define your investment objectives and stick to them. Predefined rules. Use stop-loss orders to limit potential losses and avoid emotional decision-making. Rebalancing. Periodically adjust your portfolio to maintain the desired risk-return balance. Shift your mindset. Focus on the long term. Remember that short-term losses are often temporary. Stay focused on your long-term financial goals. Think probabilistically. View investing as a game of probabilities, not certainties. Losses are part of the process. Learn from mistakes. Treat losses as learning opportunities rather than failures. Use technology and tools. Automation. Automate investments to remove emotional interference. Diversification. Spread investments across assets to reduce the impact of individual losses. Data analysis. Use historical data to understand market trends and avoid impulsive decisions. Practice emotional discipline, mindfulness and relaxation techniques. Reduce stress to make more rational decisions. Consult with experts. If emotions cloud judgment, seek advice from financial advisors. Regular reviews. Periodically evaluate your portfolio performance and decisions objectively. Case studies. Example 1. A risk-averse investor. A beginner who avoided selling a declining stock, for example, during a market correction, and incurred deeper losses. Lesson: setting a stop loss could have mitigated this issue. Example 2. Overcoming fear of loss. A seasoned investor who diversified their portfolio and accepted small losses for greater long-term gains. Lesson: focusing on overall growth helps overcome individual losses. Inspirational takeaway. Losses are inevitable in the stock market, but how you respond to them determines your success. Embrace losses as part of the journey and focus on consistent improvement. With discipline, knowledge, and a clear plan, you can turn setbacks into stepping stones toward financial success. If you found this video helpful, like, share, and subscribe for more tips on mastering your investment mindset. Comment below. How do you manage losses in the market? Let's learn from each other's experiences. Follow my channel, Star Cash, for insights on building wealth and financial wisdom.